we'll start with this quick poll. If you could just go into the right-hand sidebar and you can vote. I'm just going to launch the first poll. All right, so what area do you work in? So Southeast Queensland, Far North Queensland, Regional Queensland, or outside of Queensland? Great. We're collecting your responses.
We appreciate you guys sticking with us while we sorted that sound problem out.
Paul just said, we appreciate you sticking with us while we sorted out our sound problem. I've got the control of the microphone today. All right, so 56% of you are from Southeast Queensland. I'm going to try and share this poll. All right. All right, I'm going to close that poll down and share it with you guys. Okay. So hopefully you can see that poll of what's happening. 89% of you voted. Thanks very much. Great. Okay, and I'll just quickly let you know that you can download our handout in the sidebar. We've got the banking webinar handout. This is what it looks like. It's fabulous. Our graphic designer did it for us. Okay. All right, the next poll. How regularly do you see clients with debt problems? I'm going to launch this poll. All right, it's collecting your responses. Oh, so many of you frequently see clients with debt problems. Okay, I'll give you another 30 seconds. All right, I'm going to close that poll off and share the results with you. All right, most of you are very experienced in giving clients advice with debt problems. Okay, now let's get to the presentation part. So I'm going to hand over to Paul.
All right. What I'm going to say right at the beginning is there's a lot of detail in these slides that we're probably not going to get through in as much depth as you'd like. So what I'm going to do is I'm going to answer as many questions as we're going and then make sure we leave time for questions at the end. In light of the technical difficulties, I'm going to hang around for extra time following 11 o'clock to answer as many questions as people have. On with the presentation. So most of you already know the history of the Banking Royal Commission. So what I'm going to do is dive straight into the recommendations. The thing I would say about the recommendations that it's really important to remember is at the moment, none of these recommendations are law and none of these recommendations have been implemented. However, the government has indicated that they support all of the recommendations. But before it becomes law, they might have to enact legislation or a regulator such as ASIC, the Australian Securities and Investments Commission, might have to change one of their processes, or in the case of, say, the banking code, the Australian Bankers Association may have to make changes to their code before these recommendations come to pass. Having said that, let's dive in to the specific recommendations. And to start, I think the most important one for the type of vulnerable consumers that we all deal with is the introduction by the government of what's called an industry-funded compensation scheme of last resort. And why this is really, really important is previously when you got an ombudsman decision in your favour if you're a consumer and you had compensation awarded, the problem was that if that company, say, had gone into liquidation, you had no way of getting the compensation. And as you can see from point 2 on that slide, up to $30 million of unpaid determinations existed with the old ombudsman schemes before this scheme was introduced. So what the government's doing is introducing going forward a scheme whereby if you're successful in AFCA, which is the new ombudsman, and your company's gone bust or you're unable to recover that money from them, this scheme will assist you by paying that compensation. We're still waiting the exact detail, but I think that's a really, really important thing for our vulnerable consumers. The other thing I'd say that we need more detail on is the government has also said AFCA's jurisdiction is going to expand for a 12-month period so that they can look to disputes all the way back to 1 January 2008, which our consumer previously hasn't had looked at. The really important thing about this is normally these type of disputes, you can't bring a claim after 6 years have passed from when it happened. So this potentially opens up, and my maths, depending on the day, can be bad, it potentially opens up an extra 5 years and 3 months worth of time going back that people could lodge a complaint about. And I think that's a really, really important thing to be aware of. We're still awaiting confirmation of exactly what that looks like, both from the government and AFCA, but I think that's something really, really important to be aware of, because it means the usual advice that I would have given about a complaint being out of time may no longer apply. So we have to be really careful, all of us at the moment. If somebody's got a complaint within this time period, I'm not sure we can any longer say that they definitely have a time-barred claim. I think what we can instead say is, look, under the current law, you can't bring a claim, but there's this new initiative starting that may allow you to bring a claim instead. And I'll also say, while we're going, if you want to send questions through as we're going, I'm happy for that to happen as well, because that will allow us to answer those questions as we're going. All right, the second thing I wanted to look at, and this is probably my major disappointment out of the Banking Royal Commission, there's been no changes to the responsible lending obligation and no changes to the requirement that a lender must provide a customer with a product that's not unsuitable. Now, the reasoning in the final report was that under that test, it was designed to put an onus on lenders to do no harm in the products that they're providing. My issue with that is that doesn't sit very well with the experience I have of consumers and what they're looking for when it comes to products from a bank or a financial institution in this space, any sort of credit product. What customers are looking for is a product that's good for them. It doesn't necessarily have to be the best product, but if you tell a customer the test is the lender just has to cause you no harm, that doesn't sit very well with most consumers that I've experienced. And I think that's a reasonable complaint to have. The really important one though, and this is something that I think is really good, is that currently car yards and retail sales staff don't have to comply with the credit law. They have what's called a point of sale exemption. Now that, in my experience, had previously caused us all a lot of problems. And the reason I say that is that you had staff who are sales staff that had no knowledge of credit, spruiking products such as consumer credit insurance or additional insurance when you buy a car without really understanding what those products did for the consumer. And so what you saw and what it led to is all of these recent efforts by ASIC and the Australian Competition and Consumer Commission, whereby you had insurers paying back to customers tens of millions of dollars in insurance premiums for products that were never going to be any use to them. And so I think that's a really important thing to be aware of. The only other change that's worth knowing, there was some discussion about whether small business should be under the same responsible lending criteria as lending to customers or lending to consumers. They've decided not to do that, and the primary reason about that was concerned it might prevent people from accessing, as a small business, credit that they needed to continue with their business. All right, this is the one that, at least if you look at some of the ads in the media at the moment, is probably causing the most controversy. Those of you who've been watching TV recently have probably started to see a campaign by mortgage brokers, which is essentially, please save the mortgage broking industry from the Banking Royal Commission and the recommendations which came out of that. Now, I actually think the recommendations are quite good. Basic stuff like, if you're a mortgage broker, you have to act in the best interests of the borrower who has come to you for assistance. Similarly, there's also a suggestion that rather than lenders paying a mortgage broker a fee, a borrower should pay the fee instead. And I think that those kinds of changes are designed to stop the problem we have now, which is that there is a risk that mortgage brokers, rather than getting clients a product that's appropriate for them, what they end up with is they will provide a product, there's a risk that they'll provide a product that earns the mortgage broker the greatest fee. And that obviously is a big problem. Now, the argument from the mortgage brokers is, oh, this will reduce competition, the big banks will get more powerful, etc., etc. What I guess the problem I have with that type of argument is this, is mortgage brokers advertise themselves as providing a service to consumers that, the ads vary, but if you look at them in a nutshell, they are, we aim to get you a better deal, is the nutshell of it. And what we see in that space, and there's a good question coming through about whether mortgage brokers are encouraged to provide the product that gets them the greatest return from the bank. And that's the nub of the issue. You have a conflict of interest here. Mortgage brokers are operating in a space whereby if they're arranging a loan for a borrower, they should be getting the best deal for that borrower. And when you have lenders paying them a commission that varies between the loan and the amount of loans, in the past, the evidence suggests, they've put people in inappropriate products. Now, this is not to say all mortgage brokers act in this way, but what it is saying is that we have evidence that some mortgage brokers have, and where we have that evidence, here is a way of addressing that problem. And I think that's really, really important.
Thank you for that question.
So what we have from then on, is the insurers. And this is a big one, particularly for Indigenous communities, I would argue. We saw from the Royal Commission, there were a lot of problems around funeral expenses policies and funeral insurance. Funeral expenses policies are now a financial product. That means the ASIC Act will regulate them, which means there is a lot greater protection for consumers who are dealing with these products. And I think that's a really powerful thing. I would always encourage anybody with those, who sees clients with those sort of policies, to refer it to the appropriate credit and debt service in your state, because we all have an interest in ensuring this product doesn't take advantage of particularly Indigenous consumers in this space. The other really good things in the insurance space that I would say is there's now going to be a deferred sales model for add-on insurance products. So when we're talking about add-on insurance products, they're those products I mentioned around car yards. And when we're talking those car yard products, what we're saying is those of you who've bought a car recently, in the car yard, the sales staff will try and get you to buy tyre and rim insurance, consumer credit insurance, and variations on that, which are often unemployment insurance. The classic one I used to see was older people on a pension being sold unemployment insurance by a car yard. Terrible idea. But when you're in the pressure of that sales moment, and you might have been at the car yard for 3 or 4 hours filling the paperwork out, we often had clients saying, we will prove, or we would have signed anything just to finish the sale and get the car and get out of there. So what this model says is, rather than those products being sold immediately when you're buying the car, there will be a period of probably somewhere between 3 days and a week whereby those products can't be sold. And I think that's a really important thing. The other thing I wanted to touch on in this space is unfair contract terms. Again, there's a recommendation that they will now apply to insurance contracts. And the really important part of that is that main subject matter will be defined narrowly. Now, to take the legal speak out of that for a minute, insurance contracts are the only major contract I'm aware of that unfair contract terms don't apply to. So it's a really good thing that we're finally getting some consistency in that space around everybody being treated in the same way. And I think that's really, really important. And that's something that is a recommendation I'm hoping will come in fairly quickly. The risk is, I think those of you who've been around this space for a while will be aware that there's been promises about having insurance contracts under unfair contract terms before now, and we've never actually got the legislation. So this is one I'm really, really keen on seeing come into the legislation. All right, the other really important one I think for vulnerable consumers is there's recommendations in there around no dishonour fees on basic bank accounts and no informal overdrafts on basic bank accounts unless the customer agrees. And the reason this is really important is basic bank accounts are those bank accounts that are set up by banks that are no fee for your lower income and vulnerable consumers. And the risk of having informal overdrafts is that people might be in a position where they can no longer pay those informal overdrafts back, or dishonour fees on, say, direct debits that are set up to, say, pay a consumer lease could well overdraw those accounts. So I think for vulnerable consumers, this is another really important change. The other one I wanted to touch on is industry codes of practice. Now, for those of you who don't know about industry codes of practice, in addition to the law, industries such as the banking industry, the customer-owned bankers, and the insurers and the life insurers have all put together individual codes of practice that set out some obligations they feel they have to customers, often in addition to what the existing law actually is. And so the report suggested that it's appropriate that these code provisions, or some of these code provisions, become enforceable at law or part of your contract with the financial institution. Now, the benefit for that is it strengthens the existing law and in fact would give people rights beyond that which they already possess under the contract, which again I think is a really positive outcome for consumers. The other one that I'll touch on, because I did see a couple of rural financial counsellors and people from some rural areas around the country, is there's some really good changes proposed for agricultural lending. One of which, and at the moment my understanding is there's currently 4 states which have a farm debt mediation scheme: Queensland, New South Wales, I believe South Australia and Victoria. The proposal is that there'd be a national scheme created, which is an excellent way, I think, of ensuring farmers right around the country get access to the same rights when they become in financial trouble. The other changes suggested, which I think are also really important, are things like if a property is affected by drought or another natural disaster, you shouldn't be able to charge default interest. I think that's fair enough for our farmers. And there's also important things like when receivers are appointed, that should be the very last thing you try and do as a bank to a farmer. And similarly, ways of doing valuations have also changed. So I think that's really important. The other thing I would encourage you guys as we're going, and I know I'm going a little bit quickly, is if you've got questions we're going, please continue to send them through, because then I can continue to answer them as we're going, and as they're coming through. So that's another really important thing. Just if those questions keep coming through, I will keep answering them for you. Thank you to those who have already sent them through. All right, our next thing, and this was raised in one of the pre-webinar questions, superannuation. There are some good changes proposed in superannuation. For those of you not familiar in this space, I would encourage you to have a bit of a look at it, because superannuation affects all of us. We all have these accounts, and how they're treated is really important. The one thing I would say about this recommendation is there's a suggestion about ensuring each person has only one default superannuation account. And in terms of the fees that get charged across all, shall we say, across all superannuation accounts, that can quickly reduce small balances. So the idea of one default super account is a good thing. My one reservation about that is ensuring that people check what insurances they might have under various superannuation accounts, and working out which insurance is the most appropriate insurance for them to have given their circumstances. That's not going to be a blanket, this particular superannuation account has the best insurance. That's going to vary depending on the client's individual circumstances, and that's something that financial advice probably should be sought about, which is obviously not something legal aid can do, but it is something that other professionals will provide to you. All right, moving to our next topic, which I won't touch on because we don't give financial advice about financial advice at Legal Aid Queensland, but I've highlighted some of the main changes on the slide that's currently up. I think given what we've all seen in the media, those changes are good and an appropriate way of doing it, but I won't spend much more time on that. If you have a specific interest in that area, I'm happy to receive emails with those specific questions. Now, the second thing I wanted to flag with you is this. The thing to remember about the Banking Royal Commission was that it did not cover every single financial service. It only covered the main banks, and it only covered insurers. So what ended up happening was we saw a situation where there was a Senate inquiry launched into what I called the everything but the Royal Commission Senate inquiry. So what it looked at was things like consumer lease companies, payday lenders, afterpay, debt negotiators, and things like that. So I've given you a bit of detail behind that. That report is actually due out tomorrow. What I would say about the error in that law is that Treasury did a review, it's now nearly 3 years ago, and that had some good recommendations in it. It's led to some draft legislation. That bill has now been in Parliament, I believe, at least 3 times. I'm not sure whether it's gone back in this week. There was some talk about that, but as yet, none of those protections have been passed. So one of the things we're hoping out of the Senate inquiry is a recommendation to have that passed, because I think that's really important to increase that protection. I've covered what that also looked at. What we do want to do, just quickly, is just get a feel for how many of you guys are seeing Afterpay, Zip Money, buy now, pay later type arrangements, because I think that's something. We apologise. Looks like we tried to close that a little bit early on you. Before you got to vote. That's probably in keeping with our technical difficulties this morning, but that's okay. My experience of the zip money is that it's becoming more and more of a problem. And my issue with the zip money and afterpay type arrangements is they would tell you, and if I should add, if you are encountering really specific problems with zip money and afterpay, shoot us a question about it, because that's a good way of us getting a feel about it. But where they go wrong is they claim people don't default on their products very often. And part of the reason I find for that is that they effectively cost shift. And the reason they cost shift is they set up a scenario whereby people are keen on ensuring their particular afterpay or buy now pay later arrangement is kept open. And because they're not regulated, they claim they do. They don't have to do any assessments about people's ability to repay. So what most consumers will do, or I suspect they do, is they will pay the afterpay or zip money on a credit card, and then seek hardship on the credit card, or they will go to their existing credit providers and say, can I have hardship on my account, which will allow them to pay the zip money / afterpay and keep it open. So I'm hoping the Senate inquiry will encourage that there be a bit more regulation about that. Whether that happens or not, I don't know, but it is an emerging industry and one that a lot of people are putting a lot of money into. So I think it's really important that we look at ways of ensuring people don't end up in further financial hardship as a result of engaging with these products. All right, so just to give you an idea of some of those recommendations, what we saw was bans on unsolicited payday lending, a cost cap for consumer leases. I see consumer leases costing people 3, 4, 5 times the value of the product. And I think it's really, really important that they be treated in the same way as payday lenders, because currently right now they don't have any cost caps on them. And at least from a consumer perspective, if I see somebody with a payday lending problem, in a majority of cases, they probably also have an issue with a consumer lease. So treating them in the same way, I think, is really, really important. The second thing I'm hoping is that we have a situation where all financial products are treated in the same way. My experience of all of our clients is they don't care how a particular product is structured. If they're getting money from them, they see that as being a financial product and something that they should have protection against inappropriate conduct. And if they don't, it's difficult for them to understand why. And in that scenario, the only way I see of remedying that is that they all should be regulated by the National Credit Law, and they all should have access to AFCA. And the reason they should all have access to AFCA is that provides that cost-free complaint service without a risk of court costs being imposed on our clients. Essentially what we want is everything should be treated in the same way. So as I said earlier, where to now? The government has responded favourably to the recommendations, but those recommendations do need to be implemented. On the whole, I think there's some really positive stuff in the Royal Commission for our vulnerable consumers. All of us probably have areas from the Royal Commission where we would have liked greater change. But I'm choosing to see the glass half full on this one, and the stuff that is recommended will help our vulnerable clients. It's just we need to wait for it to be implemented by one of these ways before that happens. So if we go from there, I think we're now at the question stage. So I'll say again, if there's questions you'd like answered, please start to put them through on the question box and we can answer those as we're going. My understanding, what I will do in the meantime is we did have some questions that were pre-submitted. So while we're waiting for those other questions to come through, is what we'll start answering some of those questions. So one of those questions is around insurance claims becoming a financial service. So the effect of that is that currently, while it's not a financial service, it's not subject to things like the Corporations Act, which have duties in there to act fairly, efficiently and responsibly. The argument there, by making it a financial service, is that that opens up more rights for consumers when the insurer is not acting properly or not responding properly. So I think that's a really, really appropriate way of doing it. Another question that's come through is around personal debt at the end of the relationship. Unfortunately, there's nothing specific around personal debt regarding the relationship, but what we have in that space already is things like the Australian Bankers Association guideline, and I am aware of specific banks have actually introduced specific products to assist people in domestic and family violence situations, which I think is really, really positive. The other thing I don't think we did say is the slides will be sent out to everybody that's registered at the end of the webinar. Probably give us half a day before that goes out, but that will come out for you. All right, another question that's come through is around, does Afterpay list an inquiry on your credit file? My understanding is no. As they explain it, they have their own algorithm that takes data from a number of sources that allows them to assess whether somebody can afford to repay a loan. As much as I would love to find out what's in that algorithm to work out what they're doing, I suspect that's not something that we will see. I'm just seeing there's a couple, is everybody seeing the slides? There's a couple of, okay, that's been fixed, so that's good. Keep those questions coming through and we can continue to answer those. One of the other questions that came through was around the cashless debit card. And what I'll just say about that is that's really a different issue to a financial service, because that's something that the government's decided to introduce in particular areas. What I would say about that is if that's something you would like more information on, please feel free to send us an email and then we can go work out whether doing a webinar is appropriate from there. I can see another question there around unfair terms and insurance. Unfortunately, backdating unfair terms and insurance is not something we're able to do. Law, as a general rule, only applies going forward. So in that respect, as much as that might be disappointing, I think it's really important that we take the good out of it and the fact that going forward, these products are going to change. Do Afterpay and Zip Money list defaults? On that respect, all I can say about that is I happened to be at the Senate inquiry when both those companies were giving evidence, and what they told the Senate inquiry was no, they don't currently list defaults, which is a positive and something that's beneficial to our consumers. I obviously can't confirm that beyond what they've said about it. I think that's something we should monitor and something we should watch to see whether that product or that process changes. So that's a really important thing. So keep those questions coming through. Another one that is affected, and there's a number of questions that have come through around specific clients and specific circumstances of the clients. I'm not going to cover specific circumstances of the clients on a webinar like this. So regarding other questions that have come through, what else have we got? The other thing I probably didn't cover, specifically at least, is what in there addresses Indigenous type issues. And what I'd say in that space is there's a couple of things that address Indigenous type issues, and one is the funeral expenses insurance that I covered earlier, And secondly, there's a recommendation that the banking code be changed to address specifically issues around remote and regional communities, and ensuring that they're able to access banking services, which I think will be a really good thing going forward, particularly for Indigenous and your more remote communities, because it might improve the quality of banking services that they apply. Another question come through about specific institutions that have products or processes for dealing with victims of domestic and family violence. If you were to Google, say, one of the big four and family and domestic violence policy, you will see those results come up. And they are getting much, much better than they were, say, 2 or 3 years ago at recognising and dealing with people who are in the family and domestic violence space, which I think is really good. There's another question here about, will the recommendations be applied to new contracts, which I think is another really important question, specifically the overdraft idea, etc. I would hope that even if the recommendations in the law don't apply retrospectively around overdrafts, I would suggest that the community expectation is that that would be applied to all products by a bank, and I think that's a really important thing. I would note that we've hit 11 o'clock, guys. We're happy to continue answering questions for a little while longer, but if you have to go, thank you for attendance and thank you for putting up with us while we sorted those technical problems. That was greatly appreciated. My offer around the email is genuine. If you've got other questions that you can't stay to see answered, just please shoot me an email and I will answer them. And I would encourage you to fill out the survey that comes up at the end. But in the meantime, we'll continue answering some more of the questions. So, there's an issue around clients having Centrelink benefits, having money reimbursed to them on overdrawn accounts, as in accordance with the 90% rule in place when they attend a banking branch. Look, one of the things I see with banks generally is often the people in the face-to-face branches don't have much authority. So if you've gone to the branch and tried to get that resolved and it hasn't resolved, unfortunately, you're going to have to take it to the next step of a complaint process so that you can get into the internal dispute resolution area, because unfortunately, as much as they'd like to help, they can't actually help, because if they did, they'd get in trouble, which is a big problem. So if that's been something you've experienced, I would encourage you to take it to the internal dispute resolution area. And if I would also consider taking it to places like the Code of Banking Practice Committee, because those sort of things are important for people to be aware of, because unless they're taken up, they're not fixed. And I think that's a really important way of thinking about it and a really important way of addressing it. Another question that's come through that I haven't answered is around extended warranties being subject to the deferred sales model. At the moment, my understanding is it's add-on insurance that's addressing it. But as I understand it, the issue of extended warranties is still being looked at by regulators, because, as I'm sure you've experienced, extended warranties are a problem because they often don't provide any greater value to you than you would normally get from the Australian consumer law and what are consumer guarantees protecting you under that Australian consumer law. So if you have extended warranty problems, I'm all for hearing about those, and I'm all for you talking to people like the ASIC about them, because that's the sort of thing they should be interested in. All right, just looking to make sure we've covered all the questions. The other thing that's come through is around questions about accessing advice for people who might be in prison or people who might, say, be in a mental health ward. Certainly that's something Legal Aid and I know the other legal aids and community legal centres are happy to try and arrange. I would encourage you to contact your local centre. In Legal Aid's case, ring our call centre or send me that email, and we're happy to try and arrange those advice appointments, because we understand it's difficult, say for people in prison, to be able to access those advice appointments. And so there are special arrangements. We have a specialist prisoners advice team. In Queensland, there's also the Prisoners Legal Service, and there's a great financial counsellor that I'm aware of that works with them. So there are options like that available. So final call for questions. I'll give you a minute to pop those through. The other thing we probably should think about doing is look at this idea of you will see in the way of these things, the media will often call this the Banking Royal Commission, and this is probably one of the things I haven't covered yet. We've called it the Financial Services Royal Commission because that's what the legal documents called it as, but it's essentially the same thing. And the other, it's really good to see that we're not seeing much of the, I'm getting some comments suggesting we're not seeing much of the issues around Afterpay just yet. I think that's coming, and that's, unfortunately I do, but that's all right. If and when you see those problems, I would encourage you to talk to us, because there should be things that clients have access to in that space. So what I might do now, given it doesn't look like there's any more questions coming through just at the moment, is I might pass you back to Alan to finish up with the webinar. I really appreciate you staying with us, and like I said, any questions, just send them through later.
Thank you. Thanks everyone for joining us today. I'd just like to put a quick plug out to our next webinar on the 29th of March. It's about the Early Intervention Child Protection program here at Legal Aid, and we'll have a great lawyer from that team presenting. So keep an eye on your emails if you're subscribed to our webinar mailing list. If not, you can ask to be added. Just give me a quick email at communitylegalaid, so that's ed, at legalaid.qld.gov.au. And also, head note, our Legal Aid newsletter has just been released for February. So that's available now on our website if you want to have a look. And this webinar will be posted on our YouTube channel, and I'll try and get that up there as quickly as possible, hopefully tomorrow. And closed captions will be coming on that YouTube video shortly after that. And I'll also send out the PowerPoint slides. So you'll receive an email follow-up from me with the PowerPoint slides of this presentation. Okay, thank you everyone.